Silver investors, war just turned into economic warfare, and gold, silver, and oil are the only three assets trading on necessity instead of opinion. Source code speaking. OG John AG breakdown, but in my voice. No courses, no signals, no VIP group. Financial warfare education only. Verify everything yourself. War in the Middle East just escalated faster than the headlines on your phone could update. Physical gold and silver traded all weekend while COMEX slept, and the gap between paper and reality blew out. In this video, I'm going to walk you through what actually happened in Iran, the Gulf, and the Strait of Hormuz, not the sanitized version. How gold quietly traded up towards $6,000 in the dark market, while the official price stayed stuck near $5,278. Why silver at $120 in Shenzhen, with dealers refusing to sell, is the loudest signal we've seen in this bull market. And what to watch tonight when Western futures finally open and have to catch up to a world that moved without them. This is not investment advice. This is how the board actually looks before the opening bell. Segment 1. Two of Iran's top leaders gone. An escalation instead of de-escalation. Let's start with the war, because your metal price is just a translation of this. Iranian state media has officially confirmed that Supreme Leader Ayatollah Ali Khamenei has been killed in U.S.-Israeli airstrikes. Former Iranian President Mahmoud Ahmadinejad was also killed in a separate strike, according to Iranian outlets and Fox News. This isn't a rumor. This is what Iranian state TV is calling martyrdom for its top figures. Many Western commentators assumed if Khamenei is gone, the regime will seek de-escalation. The exact opposite happened. Since yesterday, Iran has launched 165 ballistic missiles, 2 cruise missiles, and 541 drones toward targets across the region. Air defense did work. Partially, 152 ballistic missiles were intercepted, 56 drones destroyed, but 35 drones still hit land. At least 21 of those strikes hit civilian targets in the UAE just this morning, turning the Emirates into a war zone with deaths, dozens injured, and moderate damage to homes and infrastructure. On top of that, Iran publicly claimed it targeted the U.S. aircraft carrier USS Abraham Lincoln with 4 ballistic missiles. The Revolutionary Guards confirmed the strike attempt via state media. Whether those missiles connected or were intercepted, we'll find out, but the message is clear: no red lines. Iranian officials are now saying openly they will not bow, they will continue responding. No red lines anymore. That phrase, no red lines, is the moment every risk model on Wall Street breaks. Segment 2, where physical markets broke away from fake stability. While missiles were flying, something else happened. The physical gold and silver markets stopped caring what COMEX printed on Friday. Everyone else was watching TV. China was watching liquidity. China's Duqm Bank issued a notice saying, if gold prices deviate too far and drain accumulated gold liquidity, they will simply shut trading down. Translation: there is so much pent-up yuan waiting to buy physical gold on Monday that the bank is already preparing for a run on their own metal. In that environment, the dark market for gold, off-exchange, OTC, and thinly traded weekend venues touched $6,000 per ounce. PAX G and similar tokenized gold products, physical backed gold on crypto rails, hit about $5,600 and then traded around $5,400, while COMEX is frozen at $5,278. That is, roughly $124 above Friday's official close. Live price discovery in a market that never sleeps. Crypto doesn't close. Physical dealers don't wait for COMEX. So those markets became the only honest benchmark while the Western system was switched off. Segment 3, the silver explosion, $120 in Shenzhen, nobody selling. Now the main story, silver. A Chinese commodities trading advisor reports that the Shenzhen physical silver buyback price jumped by almost $20 per ounce over the weekend among small distributors. That move pushed the Shenzhen buyback price to north of $120 per ounce. This is not a premium on some limited edition coin. This is the cash price Chinese dealers are willing to pay for standard silver on the ground right now. At the same time, IG weekend spot silver is quoted near $100. Hyperliquid, a 24/7 on-chain derivatives venue, is around $96. Shanghai spot silver is about $185. Shanghai silver futures are around $108. Western spot closed Friday at $93. Stack those numbers. IG versus COMEX, $7 weekend premium. Shanghai spot versus COMEX, $12 premium. Shanghai futures versus COMEX, $15 premium. Shenzhen physical versus COMEX, roughly $27 premium. The most important piece, most small Chinese silver distributors are not selling their physical silver in fear of lack of supply. So, dealers will pay $120 to buy. Dealers refuse to sell at $120. If you want to understand how broken the Western paper price is, that's it. The physical market where bars actually change hands is $27 higher than COMEX, and at that higher price, no one wants to sell. Segment 4, 3 assets that just switched from trade to necessity. The video we're building on put it in one sentence. 3 assets matter now: gold, silver, oil. Everything else trades on sentiment. These 3 trade on necessity. Let's break that down. Gold, the monetary reset hedge. It's not just inflation hedge anymore. It's the asset central banks, sovereign wealth funds, and large pools of capital buy when they stop trusting the global monetary order. Tokenized gold and off-exchange prices are already telling you. In a war that threatens energy supplies and trust in U.S. security guarantees, the marginal buyer is willing to pay well above Friday's COMEX print. Silver, the industrial shortage plus monetary kicker, it is the most important industrial precious metal. Solar, EVs, 5G, AI data centers, medical defense, you name it. It also carries 5,000 years of monetary history like gold. Chronic deficits mean that even before war, we were using more silver each year than mines plus recycling could supply. The Shenzhen $120 quote is just the first honest bid in a world that finally has to price that reality. Oil, the energy that can't be printed. Oil is not an asset class. It's the bloodstream of the global economy. You can print dollars, euros, and yen. You cannot print barrels. When the world's most critical energy choke point is frozen, gold and silver are both being repriced higher while markets are closed. All 3 assets are spiking together. That's not speculation. That's necessity. Segment 5, Hormuz. Frozen by insurance, not by headlines. Now, the Strait of Hormuz. Roughly 20% of global seaborne oil trade passes through this one narrow stretch of water. It's the throat between Iran, Oman, and the Gulf states. At the moment, it's technically open. In practice, it's functionally frozen. Here's why. Ships moving through Hormuz must buy war risk insurance, extra coverage that protects shipping companies from the cost of attacks, damage, and loss. As strikes escalated, 2 vessels have already been attacked near the strait. A Palau-flagged oil and chemical tanker named Skylight near Qassab at the entrance to Hormuz. 4 crew injured, 20 evacuated. A second ship, MKD Vion, was also hit and set ablaze. Insurance costs exploded. Premiums for a $100 million oil tanker jumped from about $250,000 per voyage to around $375,000. A 50% jump almost overnight, and the fleet responded. Around 150 tankers are now sitting at anchor in open waters, refusing to move through the strait. Oil and LNG carriers are just parked off the coasts of major Gulf producers. Maersk has suspended all Strait of Hormuz transits. So even if a politician says the strait is open, the actual reality is insurance is saying no. Captains and ship owners are saying no. Oil flows are stopped. That's a 20 million barrel per day shock to the system, plus effectively 100% of Qatar's LNG exports, some of the most important gas flows in the world, suddenly blocked. This is the definition of a violent negative supply shock. Segment 6, Iran's real strategy. Ports, not just ships. Iran's strategy goes beyond just scaring tankers. They are targeting ports, the infrastructure that cannot be easily moved or defended. Confirmed strikes include Duqm in Oman, a port specifically built to bypass Hormuz risk. Iran hit it anyway. Jebel Ali in Dubai handles about 60% of the UAE's imports, a non-oil economic lifeline. It took drone hits, damaging civilian and commercial infrastructure. Mina Salman in Bahrain, home of the U.S. Fifth Fleet, tying military and commercial assets together. Haifa in Israel, a critical energy import and industrial port. The message, we don't have to sink ships. We can hit the ports that feed the world. You cannot protect every crane, every storage tank, every terminal. Carrier groups and Patriot batteries don't stop drone swarms aimed at container yards. This is economic warfare layered on energy warfare. And it's working, because when ports get hit, insurance goes up, capacity goes down. Every exporter in the Gulf must price in a higher premium. Segment 7, the importers who get hit hardest. Now look at who depends on Hormuz. The video lays it out clearly. Between 69% and 75% of all crude that flows through Hormuz is destined for just a handful of importers. Breakdown, Japan. About 75% of its oil imports come via Hormuz. Overall, Japan is nearly 100% import dependent for crude. Japanese tankers are already turning back. South Korea, about 60% of crude comes through Hormuz. India, around 50% of crude imports come from Gulf states, roughly 2.6 million barrels per day, plus 60% of natural gas and LNG. Fuel prices spike. The rupee comes under pressure. GDP growth gets hit directly. China gets about 55 to 60% of crude imports via Hormuz, but has additional supply from Russian pipelines and other routes. They feel the price pain. They are better diversified than Japan and India, but not insulated. So, Japan and South Korea are in real trouble. India faces both fuel inflation and currency stress. China feels the burn but can absorb it more efficiently. Every one of these nations is a heavy buyer of gold and silver in normal times. In war times, that demand doesn't just increase, it reprioritizes. Segment 8, the honest bear case. Weekend premiums can exaggerate the gap. We need to be honest about something else too. Weekend premiums, whether in tokenized gold or IG silver, tend to capture the direction correctly, overstate the size of the gap when markets finally reopen. Reasons. Liquidity is thinner. Some trades are driven by panic or FOMO. Arbitrage desks that normally narrow spreads are asleep. So yes, gold at $5,400 on PAX G versus $5,278 COMEX is real data. Silver at $96 to $100 on Hyperliquid and IG versus $93 COMEX is real data. $120 Shenzhen buyback is real data. But when futures open, you can see gaps that get filled. You can see spikes that retrace part of the move. You can see sabotage pushes, engineered dumps that try to knock the premium down. The original video even admits this. Weekend premiums capture directional trend but tend to overstate the actual gap. Markets can gap then fill. Airstrikes can de-escalate. Hormuz risk can be recalculated if insurance changes its mind. Banks have coordinated paper price slams during geopolitical events before. They will try again. So the point is not, silver is definitely going to stay at $120 by tomorrow morning. The point is, the only markets that were allowed to trade did not agree with Friday's paper price. And whether the gap is $10, $20, or $27, the direction is up. Segment 9. Why this time is different. No red lines. What makes this war escalation different from the usual Middle East headline spike is the doctrine, no red lines anymore. Iranian statements. Confirm airstrikes will continue for days. Boast about hitting U.S. bases in 5 countries. Claim ballistic missile strikes on a U.S. carrier group. Combine that with Israel explicitly stating regime change in Tehran is now an objective. Add the Houthis in Yemen resuming Red Sea attacks. Iranian proxies being activated in multiple theaters. This isn't a one-night missile volley, a limited border clash. It's sustained military operations with regime-ending goals from both sides, on top of a choke point that the insurance market has already declared too risky to operate in. In that environment, quick de-escalation is possible, but planning for that as your base case is irresponsible. Segment 10. The structural metals deficits that were already there. Here's the part mainstream coverage always misses. Nothing about this war changed the underlying metals math. It just exposed it. Before the first missile flew, we already had silver running on structural deficits, multi-year periods where annual demand exceeded mine and recycling supply. 10 consecutive monthly green closes on silver, a stealth bull market climbing a wall of skepticism. 7 straight record closes on gold, confirming a structural monetary bid, not just a short-term panic. Shanghai premiums persistently around $12 over COMEX for silver, even before this weekend, now widened to $27 in Shenzhen physical. Industrial demand from solar, EVs, AI data centers, 5G, military, nuclear, and more, none of which has slowed down. Mine supply that simply cannot keep pace with that combined demand profile. Central banks still buying gold at or near record rates year after year. Silver lease rates spiking 6 days in a row before any of this war news hit. A clean financial signal that physical silver was already scarce. So, the roof was already dry. This war is just the match. When Western markets open, they are not pricing a new asset. They are repricing the same asset that was already mispriced. Segment 11. What to watch when markets reopen. When gold and silver futures finally open, 3 things matter more than any one tick. Gap size on gold and silver. Do gold futures open near the tokenized prices we saw, closer to $5,400 than $5,278? Does silver open closer to $100 than to $93? A small gap says paper is still in denial. A big gap says paper couldn't ignore the physical and tokenized signals. Shanghai premium. Does the silver premium between Shanghai, Shenzhen, and COMEX widen further past 27 hours? Or does COMEX catch up enough to narrow it? If the premium widens, you're seeing physical demand refuse to accept Western pricing. If it shrinks, it might be paper panic that gets faded by physical buying. Strike duration and Hormuz risk. Do strikes continue for days as Iran and Israel have signaled? Do we see more attacks on ports and tankers? Does Hormuz stay functionally frozen? Or do insurers and shippers resume normal flows? Does Brent crude hold its 8-10% weekend gains around $80, or does it spike further once full markets open? These are the real variables. Screens will show you noise. These 3 show you whether this is a 1-week spike or the start of a new regime. Segment 12. Why gold may lead and silver follow violently. In this environment, it's very likely gold leads the next move. Reasons. Gold is the pure safe haven play. It has the deepest pool of institutional buyers. Central banks, sovereign funds, pension funds. In every crisis, the first instinct is buy gold. The video rightly notes, gold may lead the next move in precious metals given the safe haven flow we're seeing. Silver then behaves like gold's leveraged little brother. Once gold confirms the move, silver's existing deficits and industrial story kick in. So you may see gold gapping to or above $5,400, silver initially lagging the full $120 physical price, opening maybe around $100. Then, as the week unfolds, silver catching up and even overreacting as the gold-silver ratio compresses. That ratio is already down near 56. Historical silver blow-offs have taken it into the 20-30 range. In a combined monetary and industrial squeeze, that move is back on the table. Segment 13. What this all means for you. If you've watched to this point, you're not here for hopium. You're here to understand. Here's what you should take away. Physical and tokenized markets traded all weekend, and they showed you where informed money values gold and silver when derivatives can't interfere. The Strait of Hormuz is functionally frozen, not just in headlines, but in actual insurance pricing and anchor counts. Ports across the Gulf have been hit. This isn't a theoretical risk. It's damage to infrastructure that takes months or years to fully repair. Structural deficits in silver and record central bank demand for gold were already breaking the old pricing regime before the first missile flew. Physical buyers in Asia paying $120 for silver aren't going to turn around on Monday and dump their metal at a loss because Western banks want lower prices. You don't have to predict the exact tick on Monday's open. You don't have to leverage to the eyeballs to take advantage of this. You just have to be honest about the difference between paper price and physical price, the difference between short-term sabotage and long-term structure, the difference between watching this like a spectator and planning like someone whose capital has to survive the next decade, not just the next candle. This is financial warfare education, not advice. 3 assets matter now: gold, silver, oil. Everything else is playing in their shadow. Invest with logic, not hype.